Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, we just had the Fed's December meeting, so I thought I'd take the opportunity in this episode to catch up on what transpired at that meeting as it relates to policy, some of the sort of observations that we have about it. And so let's jump into that. So I guess to sort of kick it off, as we've discussed before, the Fed came into this meeting a bit divided, lots of different speeches with a little bit lobbying by different members almost out in the public a little bit about, well, what are their preferences in terms of risks they're worried about. And obviously what we learn about the Fed, know about the Fed, is that they have a keen focus on a dual mandate. They want to maximize employment, but at the same time have stable prices. So maximum employment's all about jobs. Stable prices is all about keeping inflation under control. And I think going into this meeting, officials had differing views on where the greatest risks might be between a potentially weakening job market and still sticky inflation. Now, obviously, in some ways, what the Fed wants to avoid is a policy error. What would happen if there's a policy error? Well, if you cut too quickly and really kind of re-energize the economy, that could be inflationary. Inflation could reignite in that kind of scenario. But on the flip side, if you cut too slowly and tight conditions remain in place, that could drive more job weakness, but more importantly, I think, the eventual risk of recession. And so those are the risks that the officials were thinking about and talking about. Now, the other thing that got released anyway is what's called the Summary of Economic Projections. They don't do it at every meeting, but often they'll release basically projections from individual officials. It's almost like the statistics when they poll from the various officials that contribute what their views are on a variety of things. So let's get into that. So punchline is the Fed cut its benchmark rate a quarter of a point. So the reference range is now 3.5 to 3.75%. That's the lowest level the Fed funds rate has been since 2022. So we're making our way back down, but still, tighter conditions and certainly more room to cut in terms of getting back to a more sort of normalized level. Now, as it relates to cut, as we looked at Fed funds futures, essentially there was the day of or the day before the cut, basically a 90% chance. The market was pricing in a 90% chance of a cut. And so that's what transpired as it relates to policy. Now, what's interesting is there was, in fact, information reflecting a divided view. So on one hand, we saw, I think it was a total of 3 officials dissent in the vote. Normally these votes are unanimous, but we had 2 that preferred no cut and 1 that preferred a half-point cut. So the vote was divided, more divided than normal. But also what's interesting about this SEP at the end of the year is that they leave in basically what officials would have wanted in December. So think of it as a dot plot where they don't all collapse on the vote. They actually sort of put data in as to what they would prefer for the Fed funds rate. And that reflected actually 6 officials preferring no cut, and then that 1 still preferring the half-point cut. So a little bit more of a divided Fed, as we've discussed before as well. That's not a bad thing. Diversity of thinking can be good. It can lead to good, healthy debate, and you hope that discussion and debate leads to, well thought through decisions. Now, another nuance to this is that when we look at the projections or the what's reflected in terms of the future in that SEP report, we now see that officials are projecting only 1/4 point cut. And this is really the median of that data. Sort of the average view is that there's going to be 1 cut next year. And that's a little less than what the market's reflecting. Basically, the market is anticipating 2 cuts in 2026, but then interestingly, no change in 2027. All of that leads to the idea that basically the Fed's going to slow down a little bit on its rate cut activity. And if anything, the Fed is sort of saying, hey, we're going to take our time and look at things. Now, as it relates to the idea of a cut, only one cut happening from the Fed's perspective, when we look at their view on inflation, basically the SEP is saying that the 2026 median projection for core PCE, which is what they like to look at, is at 2.5%. So again, still slightly elevated inflation. And if we look back to a year ago, that 2026 view was 2.2. So inflation hasn't come down as quickly as they would like, and that's a reason to keep rates a little bit more elevated. And as it relates to break-even rates, interestingly, the one-year break-even rate, that's how the market prices the next year of inflation, is also at 2.5%. And then that for the full 5-year window is down to 2.3. So between the Fed and the market, there's a forecast of slightly firm inflation relative to the Fed's 2% target. Now, another thing that probably gave the Fed confidence to signal that they're going to slow down on cuts is essentially a stronger than expected economy, meaning they now are forecasting that median view, a growth rate of 2.3% in 2026, and that's up from 1.8% in September. That was what they thought for 2026 back in September, and that's a pretty big bump. 0.5% is meaningful. Now, the consensus forecast, the median forecast of analysts out there, economists, I should say, is at 2% roughly for 2026 GDP. So again, continued growth, no discussion of recession. Now, we talk about the idea that the Fed officials are a little bit worried about a weakening labor market. And when we look at the SEP median projection for unemployment, it's basically flat at 4.4% through the end of 2026. And that's pretty full employment. And in fact, maybe they're overly optimistic, but they in fact haircut that down to 4.2% by the end of 2027. So despite the worries about a weakening job market, their sort of forecast probably under the view that their policy is going to be effective is that basically the labor market's going to hold up okay. Now, finally, this idea that they might be pausing for a bit, that was a topic basically communicated by Fed Chair Jerome Powell in his post-meeting press conference. And a couple of quotes, or a quote, he said, quote, "We're well positioned to wait and see how the economy evolves from here," end quote. And so, he did sort of acknowledge in that session that the labor market risks did tip the scales to a cut, but they don't feel that it's, quote, mission accomplished, end quote, on the inflation front. So they're basically saying we're going to watch the data. They always do, but they're going to potentially pause here with still tight policy conditions to try to see inflation improve just a little bit more. So listen, that's what we wanted to sort of share, just a quick update on Fed activity, and really appreciate you taking the time. So we'll look forward to catching you on the next episode. Thanks so much. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.